Yesterday's minutes from the Federal Reserve's last policy meeting did not go unnoticed. The event affected the whole spectrum of assets except for some currencies. Well, we'll go over that again later. In the meantime, let's move on the commodity markets. The U.S. Department of Energy reported that crude oil stockpiles fell by 6 million barrels. However, despite such a big inventory drawdown, oil prices suffered steep losses. This can be attributed to the lingering concerns over the Chinese economy, the world's largest oil importer. Weaker than expected economic indicators and the deepening crisis in China's property sector increased the risks to the country's economy. Even an unexpected interest rate cut by the central bank failed to calm the market. In addition, oil prices came under pressure from a stronger dollar, and yesterday the greenback posted steep gains. Driven by Fed meeting minutes, which showed that most bank officials held a hawkish view on the interest rates, this contributed to the dollar's rally, thus weighing on other instruments, including commodities. This report is likely to remain in the spotlight for some time to come, and thus oil prices may shortly drop to $80 per barrel. True, this decline will be local. From a technical point of view, Brent crude continues to trade downwards and has already reached the important level of $83. This mark may act as a support, enabling the asset to hold its slide, bounce back, and recover some ground. However, traders may ignore technical signals and be guided solely by fundamental factors. In this case, oil prices will extend weakness provided that the price fixes below the 83 mark. As for gold, it was heavily affected by the minutes of the Federal Reserve's policy meeting, and the yellow metal dipped below $1,900 per ounce. With such a shift in the market sentiment, it's likely to settle there and then hit toward $1,800 per ounce. If the price fixes below the 1,890 mark, the volume of short positions will increase further. Of course, there is an alternative scenario. Given that gold is extremely oversold, it may bounce back. However, much will depend on inflation dynamics in the United States. The ruble's behavior is different from other trading instruments as usual. Instead of declining, it gained sharply, and the dollar-ruble pair is currently under the sway of fundamental factors, which causes sharp speculative price fluctuations. In such a situation, technical analysis becomes ineffective as traders focus on news events. This was due to statements from the Ministry of Finance. It reassured the market that no compulsory sale of foreign currency revenues for exporters would be introduced. True, for the sole reason that the largest exporters agreed to voluntarily sell most of their export earnings. Although there were no details on that matter, and the news still helped to cool the foreign exchange market down. Nevertheless, the latest steps taken by the Bank of Russia and the government over the past few days indicate that things are going sideways. The regulator's approach is ad hoc, which undermines confidence in the system itself, so the ruble has a better chance to lose than to gain. In the best-case scenario, the market may stabilize at around 90 rubles per dollar. Speaking of the stock market, its outlook is gloomy. The index has already approached the 3,000 mark. However, one should bear in mind that it's a deeper in overbought territory. In less than a year, the stock market has shown impressive gains, with the correction being long overdue, and the current situation with the ruble, interest rates, and the government's auction only reinforces this trend. Thus, in the near term, the index is expected not only to fall below 3,000, but to dive to the level of 2,900. And that's all for now. We continue to follow developments in the financial markets. Subscribe to our channel and follow the news with us. See you soon.